October 14th, 2025, 9:42 a.m. Columbus, Ohio. Mark Henderson, a 43-year-old independent contractor, sits in his truck outside a suburban job site. He's staring at his smartphone. He just received 2 emails within 5 minutes of each other. The first is a notification from his bank informing him that his business line of credit interest rate has just adjusted upward. Again, the second is from a real estate platform notifying him that the modest fixer-upper he bid on for his family was sold to an all-cash buyer for 20% over asking. No inspection, no contingencies. Mark pulls up a business database to see who bought the house. The buyer is a shell company, SR Residential Assets LLC. He looks deeper. The LLC is owned by a private equity fund. He then checks the About section of his bank. He looks at their top institutional shareholders. The name appears again. He looks at the manufacturer of the drywall he was about to buy at the hardware store. The name is there too. He sees the same name on his pension statement, his insurance policy, and even the label of the bottled water in his cup holder. Mark Henderson thinks he is participating in a free market. He thinks he is competing against other families for that house, and that his bank is a separate entity from his suppliers. He is wrong. Mark is not living in a market. He is living inside a simulation of choice where every outcome has already been calculated by a single set of servers in Wenatchee, Washington. To understand why Mark's bid never stood a chance, we need to look past the brand names. We need to look at the operating system of the planet. To understand how we got here, we need to rewind. Chapter 1, The Visible Story. The public narrative of BlackRock is one of passive success. It is the story of a company that simply rode the wave of the index fund revolution. In the mainstream media, BlackRock is portrayed as a fiduciary, a neutral middleman managing money for retirees and teachers. Larry Fink has famously said, "We are a fiduciary. The money we manage does not belong to us. It belongs to our clients." This is the official line. In 1988, Larry Fink and 7 partners started BlackRock in a single room. By 2025, it reported a staggering $14.04 trillion in assets under management. To put that in perspective, that is roughly half the GDP of the entire United States. The public thinks this is just a very big mutual fund company. They see BlackRock, Vanguard, and State Street, the big 3, as competitors. They see them as the helpful architects of the 401k era, providing low-cost access to the S&P 500. The mainstream story says that BlackRock is successful because it is efficient. It says that BlackRock's ESG initiatives are about stakeholder capitalism, a way to make the world better while making money. But in late 2025, a mismatch began to appear in the data. While the big 3 claimed to be passive observers, their voting records at corporate board meetings told a different story. They weren't just holding stocks, they were dictating terms. From oil companies to tech giants, CEOs began receiving letters from Larry Fink. These weren't suggestions, they were mandates. The visible story is a massive index fund. The hidden story is a centralized planning bureau that would make the Soviet Union envious. Chapter 2, The Hidden Mechanism. BlackRock is not a bank. It is not an insurance company. It is a technology firm that happens to move money. The core mechanism of their power is a platform called Aladdin. Think of Aladdin as the matrix for global finance. It is a proprietary software system that handles risk management for over $21 trillion in assets. Not just BlackRock's own money, but the money of their competitors, central banks, and sovereign wealth funds. When a Japanese pension fund, an American insurance company, and the European Central Bank all use the same software to calculate risk, they all move in the same direction at the same time. This creates a feedback loop. Imagine a row of locked doors. You think you are choosing which one to open, but Aladdin owns the keys, knows what's behind every door, and has already simulated your choice 1 billion times before your hand even touches the knob. This leads to a phenomenon called horizontal ownership. In a traditional market, Pepsi competes with Coca-Cola. They fight for market share, which lowers prices for you. But if BlackRock and Vanguard are the top shareholders of both Pepsi and Coca-Cola, why would they want them to compete? Competition is expensive. It eats into margins. The mechanism is simple. Consolidate ownership of an entire industry, use stewardship meetings to discourage aggressive price wars, and optimize for industry-wide profit. The consumer pays the hidden tax. Back to Mark in Ohio. Mark's bid on that house failed because Aladdin's data suggested that single-family rentals were a low-volatility asset class in a high-inflation environment. The software didn't see a house, it saw a cash flow unit. And because BlackRock provides the risk analytics for the banks that provide the credit, the entire chain is optimized for one outcome. The institution wins, the individual loses. This design works until one simple assumption fails. Chapter 3. The breaking point. The breaking point isn't a stock market crash, it's a liquidity ghost. In the spring of 2025, we saw a preview of this. A mid-sized logistics firm in Texas tried to liquidate a large position in corporate bonds to cover an emergency debt payment. Normally, this is a routine transaction, but when their algorithm sent the sell order, it hit a wall. Every other firm using Aladdin had received the same risk alert. Within 60 seconds, there were no buyers, none. This is the paradox of scale. When you own everything, there's no one left to sell to. The illusion of choice becomes a gilded cage. Internal communications from the crisis show the panic. One analyst asked, "Why isn't the bid showing up? We're offering 10% below par." The response was cold. There is no bid. The model says wait. Everyone's model says wait. If the model says wait, the market stops. In the housing market, this breaks differently. In 2026, as interest rates stayed higher for longer, the institutional landlords didn't sell their houses when the market cooled. They couldn't. Selling would force them to reveal billions in paper losses. So they did something else. They raised rents. They created a floor under the housing market that shouldn't exist. They broke the law of supply and demand through sheer centralized weight. Normal people tried to react by moving to cheaper states, only to find that Aladdin had already predicted the migration and bought the houses there 6 months earlier. By the time the Department of Justice finally opened an investigation, the assets were already moved into private funds where public oversight ends. Chapter 4. The system fights back. When the system breaks, the fix is usually just a rebranding. In early 2025, a new regulatory framework was proposed called the Fiduciary Transparency Act. On paper, it required BlackRock to disclose more about their private meetings with CEOs, but the official Treasury reports told a different story. They claimed that to ensure the stability of the American financial system, they must integrate Aladdin's risk management tools across all systemic institutions. Do you see the trap? To regulate BlackRock, the government decided to use BlackRock's technology. They turned the fox into the designer of the security system. The system doesn't fight BlackRock because the system is BlackRock. This creates a moral hazard of cosmic proportions. If BlackRock makes a massive mistake, the Fed cannot let them fail. If BlackRock fails, the risk management of the entire world fails. They have achieved the ultimate status, too big to exist. Every measure intended to make the system safer actually makes it more fragile. Mandate higher capital requirements, and small banks can't afford the compliance. They sell out to big banks. Then BlackRock, as a shareholder of the big banks, becomes even more powerful. On paper, the system looks safer, but for someone like Mark, the ground under his feet is actually thinner. He isn't just a customer anymore. He is a data point in a circular economy where the same entity lends him the money, sells him the materials, and owns his landlord. Final verdict. The Great Reset is not a future event. It is a current architecture. Here is the cold reality of the 2026 landscape. First, competition is a branding strategy. You are not choosing between different companies. You are choosing between different storefronts for the same institutional capital. The friction of the free market has been replaced by the efficiency of a monopoly. Second, you are being outcomputed. Your bid for a home, a job, or an investment is being processed against an AI that has more data on your behavior than you have on your own bank account. You are playing poker against someone who can see your cards and the next 3 decks. Third, the safety net is a filter. Government protections are designed to ensure the flow of capital remains uninterrupted, not to protect your individual wealth. In a crisis, the system will save the operating system and let the users crash. Fourth, ownership is being phased out. The secret plan for 2026 is the transition from an ownership society to a subscription society. Homes, cars, and even tools are being moved into institutional hands to be rented back to you at algorithmically optimized prices. The real risk is not a single crash. It is the slow, silent evaporation of your ability to participate in an economy you don't own. The choice was never yours, only the illusion remains. Data stream terminated.